Well, good morning, you guys. I want to again welcome everybody. I want to thank all of you. What a beautiful day to be outside, and so thank you so much for attending. We want to be respectful of your time, so we're going to get started. But, you know, one thing I wanted to tell you is we work very hard to try to provide extra value to all of you, because I think all of you are clients as I look around the room. And so one of the things we wanted to do this year is provide some educational events. And I couldn't be more excited about today, having the two gentlemen that I'll introduce in a minute here to discuss a very timely topic, and that is taxes. So what you can look forward to additionally, if you're interested, is 3 more educational events this year. Next, we're going to have in May a event for Medicare. So if for those of you that are under 65 and know that Medicare is coming, we want to provide that to you. We do have a date, and that's Wednesday, May 21st. We'll provide more information later. Additionally, later this year, we're going to do an estate planning, so talk about wills and trusts. And then finally, our 4th educational event this year is going to be for the young professionals. So as many of you know, Tyler Peterson is part of our team, and his focus is really on young professionals. And so we're going to do an event for some of the young professionals. They can use the advice of wisdom and those of us that have a little more gray hair. So don't want you to feel excluded from that event, but that event will be for young professionals. So I do want to make some quick introductions. First and foremost, Melissa Keller. All of you know Melissa. She's our client service manager. Events like this can't happen without a lot of work behind the scenes, and Melissa does a great job in everything she does, including coordinating an event like this. So certainly couldn't do it without her, so wanted to thank her. I mentioned Tyler Peterson earlier. We hired Tyler April 1st of last year, and unfortunately Tyler has a terrible cold. He came in yesterday. He wanted to make the event. I said, please stay away. None of us want what you have. So, but I did want to recognize Tyler, even though he's not here. Very proud of him. Last Friday, he took the Certified Financial Planning exam and got a provisional pass. The way that works, I'm not going to get into great detail, but he'll get the final notice, but very confident he passed that exam. He spent a lot of time studying for that exam. We're very excited. It brings additional knowledge to ultimately all of our clients. So we're very proud of Tyler. He's done a great job. Next, I wanted to introduce, before I bring them up, and I'll let them introduce themselves a little bit, but Mike Brinker and Alex Song are here from MHCS. They're a regional accounting firm. I've got a long-standing relationship with them. They do a great job. And, you know, this is their busy season, so I'm really grateful to both of them for taking time out of their very busy schedules right now to present some really great information to all of you. So thank you both for being here. Brad from Russell Investments, also have a long-standing relationship with Brad and Russell. Brad just moved to the Des Moines area, and Brad is going to introduce, after Alex and Mike get done speaking, a little bit about a specific tax strategy. But Russell has a host of tax managed accounts and then some unique other offerings that Brad's going to mention during his time. I also want to thank Brad. Brad is a sponsor, so Brad is actually sponsoring this event with us. So Brad, thank you so much for being here. Lastly, Caitlin Prohaska, you can see there's a camera, there's a video going. So we're hoping that this our time together and this information is not only valuable to you, but also valuable to some of our other clients and also our prospective clients. So we are videoing this, and Caitlin is nice enough to do that for us. So don't be intimidated, and because she's going to keep the camera up here. But if you want to, get a shot, come on up. But no, thank you so much, Caitlin, for doing that. So our agenda very, very quickly, Mike and Alex are going to speak for about 30 minutes. We'll have Brad speak for about 15 minutes, and then we'll do a little Q&A. So I know those guys want it to be interactive, but you might want to hold your questions to the end just so they can get through all their information. But again, this is for you, so we want to make sure this is valuable to you and you get all your questions answered. I do want to mention we're going to take just a quick break after Mike and Alex are done speaking, just so we can take a pause on the camera and then restart it once Brad is speaking. Your folders have information. There's a PowerPoint presentation that Mike and Alex are going to go over. It'll be up here on the screen. But again, you can take notes. The PowerPoint presentation is in your folder, as well as some information on some of the things Brad's going to talk about. And then also another strategy that Mike and Alex will mention is donor advised funds. Those have really become very popular. And so there's some information in your folder on that as well. Lastly, following this meeting, we are probably going to follow up. One of the things that we subscribed to last year was some software called Holistiplan. And it's a tax planning software, and it gives us the ability to take your tax return and get some different tax strategies utilizing this software. So if you're interested in that, and we really are trying to integrate into our practice tax strategies, it's very important, and I think that makes us unique versus some other advisors that may not take taxes into consideration. So if you're interested in that, we will have that available and certainly want to provide that to you. So before Mike and Alex come up, I do want to recognize a special couple that has an anniversary today. So sorry, they might kill me, but Deb and Dennis have their anniversary today. So I really am flattered that they would spend their anniversary being here with us learning about taxes. So, so Mike and Alex, I will let you have the floor. Again, I want to thank all of you for being here. It really means a lot, and I really hope you get a lot out of this presentation. I think you will. So, Mike and Alex.
Well, JR and Melissa, thank you so much for putting this together, and thank you for inviting us to be part of it. We are spending a lot of times at our desk this time of year, so it's good to get out and see some faces, have a good lunch, and then get away from the desk for a while. So thank you for the opportunity. I was a little worried. JR said he wanted us to come and talk about taxes. I kind of felt like we were the mandatory presentation at the timeshare sale before you get lunch. So I'm glad everybody had lunch before we got to speak. So hopefully we can give you something to take home today. Alex Song works for MHCS. He's one of my key people there. I've been in the business over 30 years. I started when I was 15, in case anybody was wondering. But no, we're going to try to give you a few tidbits today. It's a common theme right now, good time of year to learn about taxes. Real quick, if there's one thing you take home today, tax payments right now. The IRS is kind of in disarray right now with some labor cuts. Post office is not doing a very good job. I'm advising all my clients to make their tax payments electronically. I know for some people that are uncomfortable with doing that, don't want that. I think the risk of doing that, the benefits of doing that outweigh the risk of the post office or the IRS losing your tax payment, not processing it timely. You're going to spend a lot of time on the phone getting that straight out. So that's the one thing that take home today, as you get ready to make your tax payments here coming up. So, Alex, anything to add before we get started? Or
No, I mean, I'm glad you guys got full bellies now, and hopefully you guys can take something away from this. So, yeah.
So we're going to just go through a series of 12 things here, no particular order, but this is kind of our, things to keep in mind as we're going through the end of tax season here. Some of these are tried and true strategies. Some of these are things that maybe you've never heard before, or just a different twist on it. And we're also going to talk about some of the expiring tax cuts that are set to expire here after 2025, and then also talk a little about Iowa income taxation. So just wide variety of things. They'll kind of tie in and out, and we'll just kind of bounce around. So,
Yeah.
Alex, why don't you get us started here with
So
the
yeah,
first thing?
we kind of came up with, or Brinker actually came up with 12, strategies for wealth preservation. So first being maximize contributions to tax advantage retirement accounts. So these are your 401k contributions, backdoor Roth IRA, mega backdoor Roth, SEP IRA or solo 401k, and then defined benefit plans. So these are just ways that you can contribute to your retirement accounts. You get tax advantages either, whether you're contributing to traditional, you get your deduction off your taxable income. But then also it's like Roth IRAs, if you contribute to Roth IRAs, those grow tax-free. So when you get the distributions, you're not paying tax on those because you're paying them now. So.
Seen a lot of activity in the backdoor Roths over the last few years. People wanting to put more away from retirement. They've maxed out their 401ks and the traditional, so they do a non-deductible traditional IRA contribution, and then they call JR a couple days later or immediately and say, hey, I want to convert this to a Roth right away. So you're not getting a deduction for it, but it's still a non-taxable event, a way to get some more money into a Roth IRA. And then the second thing right below that, the mega backdoor Roth, that's probably not used quite as much, but that's in an employer. If you're in a 401k and you're maxing out your deferral at like the $30,000, or it's roughly $32,000, I think, if you're age 50 or above. If you already reached that, there is another strategy, and your employer plan has to allow for it. But I'm seeing more and more allowing this. You can do after tax contributions into your retirement plan. Jay, I don't know if you're seeing people do this as well, but it's a great way to save more for retirement. You put in after tax dollars into your 401k, and then you immediately convert inside the 401k to Roth. So that's where if you hear this term mega backdoor Roth is what they're referring to.
Yeah, so second, we optimizing charitable giving. So we're seeing donor advised funds a lot, which JR mentioned as well. Those are just funds that you can put multiple years of charitable contributions in a single year to claim a larger deduction while maintaining control over the distributions. So you actually get control of where that money goes, what charities you want to contribute to. Another option is qualified charitable distributions, QCDs. So you can use up to $100,000 per year from an IRA for charitable contributions tax-free if you're 70 and a half or older. So this avoids increasing the AGI and counts as a required minimum distribution. So the last one is donate appreciated assets. So donating stock or other assets instead of cash to avoid capital gains tax and claim a fair market value deduction.
Let's stay on that slide just for a second, Melissa. So all three of these, but especially the first two, were kind of driven, especially in the last few years after the Tax Cuts and Jobs Act in 2017. They increased the standard deduction. A married couple, the standard deduction's like $30,000. And then they also put this SALT limitation in that basically says you can only deduct $10,000 of your state and local taxes. Well, if you got your mortgage paid off and you're hitting that $10,000 cap, it's hard for a lot of people to itemize deductions anymore. I just see less and less of it because of that higher standard deduction. This is kind of a way around that, or to still get some tax benefit out of your charitable contributions. The first one, the donor advised fund, maybe, if you traditionally give, 10,000 a year to charity or something like that. If you're not itemizing, you're not getting any benefit out of that. But say you want to front load it and give 5 years at once or 10 years at once. So, you go to JR and you say, hey, I'd like to set up a donor advised fund. You fund that with $50,000 or $100,000 up front. The money's there and you can use it for charitable purposes over the next 5 or 10 years and designate where the money goes, but you get that tax deduction when you fund it all up front. So it's a really good way to still get some benefit out of your planned giving that you're going to be doing. The QCDs, the qualified charitable distributions, those are another kind of a way around that not being able to itemize your deductions. In essence, you're taking money out of your IRA and you're not getting taxed on it. So you're kind of getting a deduction that way just by not picking it up as income. So those have increased a lot in popularity lately. And then the donate and appreciated assets, that's been around for a long time. If you've got stock sitting in an account and it's appreciated, donate that to a charity. You don't have to pick up the gain as income. And if you do happen to itemize, you can still get a tax deduction for the fair market value. So that's kind of a double benefit if you're able to do that.
Yeah, so next, managing your investment income. So this is where working with a guy like JR comes very handy. So 3 ways is tax loss harvesting, offsetting your gains with losses by strategically selling underperforming investments. Tax efficient investments, consider investing in municipal bonds, tax exempt at the federal level, or tax managed funds. And then capital gains timing, so deferring your gains into future years or managing sales to take advantage of long-term capital gains rates.
Health savings accounts and 529 plans, again, nothing new, just we're seeing more activity in these lately. The HSA kind of got forgotten about a little bit for a few years. It was real popular at first, or thought it was going to be, but the health plans and the deductibles and the premiums didn't quite match up to make them really that beneficial. I think that's adjusted now in the marketplace. The nice thing about the health savings account is if you have a high deductible health plan, and it doesn't take a lot to get to that anymore. If you're maxing out your 401k and your IRAs and all that stuff already, dump some money into an HSA. I mean, you can use it for your out-of-pocket health, but I see more and more people just parking it there, and then they have that pool of funds to use in retirement to pay for health here. Don't think of it as a way to use it right now. Put money away for retirement and get a tax deduction for it now. It's great. It's triple. I mean, you get a deduction going in, you get tax deferral on the earnings, and then it's tax-free when it comes out if it's used for medical expenses. So that's a very popular one. 529s, those are to pay for, used to be higher education, college tuition. Now they can be used for K through 12 tuition as well. So I see a lot of grandparents setting those up for the benefits of their grandchildren to pay for K through 12 tuition. And then one other piece on there that came out recently is if you don't use all the money in the 529 plan, there is an option to roll that over to a Roth IRA, and that's fairly new.
So the qualified business income deduction, so this is something that was implemented in with the Tax Cuts and Jobs Act. So this is for pass-through entities, so S corporations, LLCs, partnerships. So basically what it is a 20% QBI deduction under Section 199A. So to maximize this, you want to reduce your taxable income to stay below the phase-out thresholds, which are $364,200 for married filing joint in 2024. And then you want to adjust reasonable compensation for S corporation owners to optimize W-2 wages. So basically, this is just something, if you have a bunch of pass-through entities that you're invested in, that income, for the most part, comes through as qualified business income, and you get a deduction on your 1040. So
the QBI came out when they lowered the C Corp tax rate down to a flat 21%. This was kind of the equivalent of that to, they didn't want a flood of businesses flooding all going to C Corps because of this lower tax rate. So they tried to lower the pass-through tax rate by giving this QBI deduction along with it. And it's a very valuable deduction with some other things. It's one of the things that's set to expire here at the end of 2025, and we'll talk a little bit about that coming up.
Yeah. So considering Roth IRA conversions is a big deal too. So if you convert traditional IRAs to Roth IRAs in low-income years or before retirement when marginal rates may be lower. So this is essentially those years that you're not paying as much tax, your rates are a little lower. You want to pay the tax on the money now, put it into a Roth, so it's tax-free growth. So you can use other available tax attributes, net operating losses, bonus depreciation, et cetera, as a window of opportunity for conversions. So you want to pay taxes on the conversion now to enjoy tax-free growth and withdrawals later.
This is another popular thing in the last few years. When the tax rates went down in 2018, there was an opportunity to do this, convert it at a lower rate, and then if you can find a dip in the market and time it and do it when the market's down as well, it lowers your threshold for paying tax. I see a lot of people doing it in the years maybe after they retire and they don't have that earned income coming in as much, but they're not at the RMD level yet. So there's kind of a window in there to convert, and then you never pay tax on it again. There's no RMDs on the Roth. Your heirs never pay tax on it as well. And now, even better, Iowa last year started making Roth conversion income exempt from Iowa taxation as well.
So cost segregation studies and bonus depreciation. So for real estate investors, accelerating depreciation and deductions through a cost segregation study to maximize tax savings on rental properties. So basically, this is like taking a property, seeing what assets in that property are, for example, like 27.5-year property versus 5 or 7, like fixtures, like furniture, stuff that depreciates quicker. So you can get bonus depreciation on that. And also there's a route for Section 179 as well. But really just taking advantage of that extra depreciation you can get for certain assets. But with the Tax Cuts and Jobs Act, that's been phasing down year to year. So it's not as much as it used to be, but it's still a benefit though.
Right. Net unrealized appreciation strategy, kind of a narrow type opportunity, but if you hold like your employer securities in your 401k, you've been granted shares over the years, maybe at a low basis. If they're in your 401k, you're going to be taxed when those come out as ordinary income. If you meet some specific requirements, and again, it's a very technical thing, you can take a lump sum distribution of those employer securities out of your 401k and get taxed. You get taxed at ordinary rates, but only on the basis. And then when you ultimately sell those shares, you get to pay tax on that at capital gain rate. Well, the top ordinary rate is 37% right now. Capital gains is 20%, so there's quite a difference in that. So if you have some employer securities, the employer you work for in your 401k, I encourage you to talk to your financial advisor and tax advisor about this opportunity.
So income-related monthly adjustment amounts. So IRMAA is an additional charge on Medicare premiums for individuals with higher incomes. So IRMAA can increase Medicare B premiums from $175 a month base rate to as high as $594 a month. So the 2024 IRMAA starts at modified adjusted gross income of $103,000 for single and then $206,000 for married filing joint. So appeals can be made due to life-changing events or incorrect IRS data. Tax planning strategies can help reduce or avoid IRMAA in future years.
Alex, we call it IRMA. IRMA, but IRMA's not your aunt in Wapello County. IRMA is income-related monthly adjustment amount. This comes up, sometimes catches people by surprise. So back to the Roth conversion. Say you decide to do the Roth conversion, and your income's been down here, around this $200,000 or less level for a while. Well, you convert a bunch of Roth. Suddenly, Social Security Administration gets a copy of your tax return from the previous year, and it's like, oh, you're subject to IRMA now. So your Medicare premiums, can jump from $175 a month, and it's bracketed based on how much income you have, but it can go up to almost $600 a month. Now, that'll go back down the following year after they get your next tax return, but it can catch some people by surprise. So I encourage people to be aware of this if they're thinking about the Roth conversion or they have another, income triggering event that they wouldn't normally have, not to be surprised with this. Now, the appeal, there's a pretty narrow window of things that qualify for that. I had one last year, a taxpayer, her husband died. She had to sell the whole farm business and some cattle and everything because of it. But it was because of his death that she had to sell all that, and it generated this huge capital gain. We were successful in getting her IRMA adjustment removed pretty quickly. I was surprised that the Social Security Administration responded, within 3 or 4 weeks on it and took it away. So just something to be aware of.
Gifting and estate tax strategies. So the annual gift exclusion is you can gift up to $19,000 per recipient per year. That's in 2025, without using your lifetime exemption. So lifetime exemption is so that's $13.99 million per individual in 2025. So the point of that is to utilize the federal estate tax exemption to transfer wealth tax-free. So you can consider strategies like grantor retained annuity trusts or intentionally defective grantor trusts.
That's something that we'll talk a little bit more about the expiring strategies, but the estate tax attorneys were very busy at the end of last year working with people on that, not knowing what the election was going to do. I think with the election results now, they think there's going to be an extension to that, but it's still something to keep tabs on.
Yeah, so we've talked about the Tax Cuts and Jobs Act. So there are some sunset provisions that, they're expiring in 2025. We still don't really know if they will be extended or not yet. It's still kind of up in the air. But the top individual tax rate is currently 37%, but will go back to 39.6%. The standard deduction was doubled and personal exemptions eliminated. Those will go back. Child tax credit will revert from $2,000 per child back to $1,000. SALT deduction cap will be, that $10,000 will be taken away with it sunsetting. The qualified business income deduction in total, that'll be sunsetting as well. Estate tax exemption doubled under Tax Cuts and Jobs Act to $14 million a person. That'll revert back to $7 million. So yeah, it's very likely there will be an extension of some sort with all these positions. It's just kind of up in the air with the government right now. So
just a reminder on how that works. When there's a tax cut, any tax cuts that pass, it has to be revenue neutral. They have to find a way to pay for it. So one of the accounting tricks that they do to make things look like it's going to pay for itself or that's revenue neutral is they put a sunset provision in on these tax cuts. So back in 2017, for the cuts that took place and started in 2018, they put this sunset provision on, so they're going to end after 2025, everything reverts back to what it was. They have no intention of that ever happening, but that's how they get the bill to pass and meet all the revenue indicators that it means to. So if they do nothing, this is exactly what will happen. Tax rates will go back up to what they were. Now, politically, that's a tax increase, and people don't like to have tax increases. So all belief is that they will extend these in some form or fashion. There may be some tweaks along the way. It's a question of how long they can extend them for. They had from 2018 to 2025, a 7 or 8 year window. I don't think they're going to be able to get it through that long on the next extension just to get it paid for. It might be a 5 or 6 year extension of them. So we'll just wait and see. But it'd sure be nice if they would do it now so we know what to plan for in 2025 and it makes it awful difficult for business owners to know what kind of, and individuals to know what kind of environment they're in to do any tax planning. But we're coming up on our 100 days here pretty soon. I have not seen any tax bills coming out, so my confidence getting less and less that anything will happen anytime soon.
yeah, so the final piece, so Iowa's had some changes in these recent years. So we're heading towards a flat tax rate, which is in effect January 1st of this year. So this is a flat rate of 3.8%. The historical rates, 2024 was 5.7, 2023 was 6.0, 2022 was 8.53. So the effect of the 3.8% rate on a person with $250K taxable income is a $4,000 tax decrease for 2025 compared to 2024. That's just just an estimate, example,
Yeah.
just to see how the effect goes. And then they also implemented the exemption of retirement income from taxation, Social Security, pensions, 401K, and IRA distributions, including the Roth conversions that we talked about earlier.
Yeah, Iowa's gotten real tax friendly over the last few years, both with businesses and individuals. I think they were trying to get around the, retire and move to Florida or Texas, where they don't have state tax. Iowa's, a 3.8% rate. I can live with that and have the quality of life and maybe not the hurricanes that they have in Florida and stay in Iowa. The 3.8% rate, a $4,000 tax cut, that's real dollars, for a working family of $200,000 of income. So that, I think people are seeing the effects of that in their paychecks here in 2025. And as you get ready to pay your estimated taxes for 2025, you'll see a decrease in your Iowa taxes. So all good stuff. Everybody's still awake, Alex. So
Yeah, good.
I'm glad they had
We
soup
onboarded
and not
everyone.
something heavy. Question in the back here.
Could you expand a little bit on the relationship between Roth IRA conversion to Roth and the impact of starting to take RMDs.
Okay. So Roth IRAs are not subject to RMDs. Your traditional IRA, you have to start taking required minimum distributions when you reach, depending on when year you're born, either 70 and a half or up to 73. Roth IRAs are not subject to that. So the money can stay in there as long as you want without taking distributions and then pass to your heirs if there's money in there when you die. Is that the question you have, or?
Well, that I understood.
Okay.
It's more, once you start taking RMDs,
Okay.
are you still allowed to do Roth conversions?
Yes, you are. There is no longer, there used to be an age limitation on where you could contribute more to IRAs or do conversions, but that went away with the Secure Act, didn't it? 2.0 JR, when that went away?
Yeah.
So yes, you can do conversions at any time.
And let's just assume I have to start taking RMDs.
Okay.
Is there a way to take that RMD and do a Roth conversion on it and?
No, I just went through this with somebody. In the year, you have to do your RMD and then you can do the conversion on top of it. You cannot use the conversion to count for your RMD. Good. I think that, yes.
Want their tax money.
Yes. Yes.
On the health savings in HSA,
Yeah.
can you use those kinds of accounts when you have Medicare?
I don't know the answer to that offhand. There is some coordination with Medicare on that, I believe.
I just, for some reason, was thinking you couldn't use that.
That seems right to me.
Okay,
Yeah.
okay.
Because I don't know if your health plan is going to qualify as a high deductible plan if you're on Medicare and a Medicare supplement.
Right, absolutely.
Yeah,
Okay.
yeah. Any other questions or tax related things we can entertain you with? Well, thank you very much. Appreciate the audience and the time to get out here. We'll be in the back here for a while. If anybody has any more questions afterwards, be sure to ask us.
Again, Brad, just to reiterate, long relationship with them, sponsoring this event. He sponsored events in the past, and now he's an Iowa guy instead of Ohio guy, right?
Wisconsin.
Wisconsin
Close enough.
guy. That's even, yeah. No comment, but Brad, thank you very much.
Thanks, JR. So a couple things to hit on initially. My wife does like to point out I have a couple gray hairs. They go away once you put the gel in. I also do want to point out JR's highlight with Tyler to start off with. I think he kind of glossed over it, but there's two distinct designations you want to have in the investment industry: CFA and CFP. CFAs, if you ever watch an MSNBC and people are issuing buy and sell ratings on stocks, CFAs are crunching those numbers. CFP is the best designation that you can have when it comes to building your financial plan, doing right by the client, and there's just a lot of time and effort that goes into it. I actually signed up for it 2 years ago, didn't find the time to study, and did not take it. So again, I just want to emphasize, shout out to Tyler for getting that done. That's a huge achievement. Mike and Alex hit on a whole bunch of good things. A lot of things that's why we work with those guys, because they know all of the ins and outs. And I think the same thing that comes to our strategies. We'll talk on what we do, tax loss harvesting, and some of the ins and outs that you may start to wonder, what is this guy talking about? That's why you work with JR. That's why JR partners with our firm. And it's a unique approach that, again, we'll get into. A couple just general things or ways I like to hit on taxable investing at a very high level. Retirement accounts are powerful because you pay taxes 2 times, the front end or the back end, right? When you get your taxable accounts, what we try to do is we try to recreate a Roth IRA. I always bring it back to one word: control. I want to control when I pay taxes on my investments, right? I don't want to have any surprises for Mike. I don't want to have any huge 1099s. I always bring up the example of my parents who are on the verge of retirement coming up over the next year or two. And my dad funnily said one day, he goes, "Hey, do you know Social Security is taxed?" So, well, yeah, absolutely, 85% of it, and you better not throw off any of those ratios because you're going to be in a world of hurt, right? Taxes come into play into everyone's situation. It's really hard to stay in the 12% bracket. If you're in the 22% bracket and above, it's 22 cents of every dollar that matters. Mike also brought up the Tax Cuts and Jobs Act. Where are taxes going moving forward? Well, tax rates change due to two reasons: how much money you make in any given year, and whatever Congress says it is. If I'm a betting man, I would say that taxes are going higher at some point in my life. Even if we get the extension 10, 20, 30 years out, tax rates will move higher. The general principle that I get back to is if my investments aren't distributing capital gains, if they're distributing minimal dividends and not giving surprises to Mike year in, year out, I get to control when to pay taxes, when I actually go to sell the position. We all do pass away someday. If I never use the funds, I pass them along to my children and they get stepped up in basis, the ultimate way to beat the tax man. Who here remembers the first paycheck that they ever got in their life? Right, I'm gonna guess pretty much everyone did. And I'm gonna guess it was less than you expected, right? And that's because taxes are a real thing. Gross pay and net pay. When it comes to investing, the same thing takes place. You have your retirement accounts, HSAs, Roth IRAs, traditional IRAs, everything in that side of the spectrum. At some point, you max all of those out. You have your taxable account, and you have a gross return and a net return. One of the big phrases that we'll use when it comes to taxable investing is it's not what you make, it's what you keep, right? It's easy to look past that number because you get your statement at year end saying you made X amount of percent. You get a 1099 2 to 3 months later. Unless you do the backhand math to show what was lost to taxes, it never comes back up, right? We don't send you a revised statement saying, hey, you actually only made 8% because you lost 2% to taxes. So it's the goal to keep those two numbers as close as we can. And the strategy that we're going to get into is going to talk about tax loss harvesting and actually giving Mike numbers to work with and saying, hey, here's losses to use. Do whatever a CPA does with these. At a high level, Russell Investments has been along for a really long time. Started 90 years ago by Frank Russell. I think it's important to kind of walk through the minute history to get to where we're at today. So we were founded a long time ago. It was in the mid-60s. Frank's nephew came to him and he said, hey, Frank, I think we could do a better job managing companies' pension plans than the bank down the road, than their buddy that they know. Like, let's go out and research the best managers out there and give them portions of that portfolio. Frank said, good luck, go out and try and sign someone up. So his nephew goes out, his first client we signed up was JCPenney. Now JCPenney is not in a good spot today, but that's not due to an underfunded pension, right? So we worked specifically in the institutional space for a good 20 years, helping set the overall asset allocation and helping find the best money managers in the world. In the mid-'80s, we launched our retail model portfolios, same type of thinking. How could someone best save for retirement? You do so through a diverse asset allocation. You do so through finding the best money managers in the world. The funnel here does a very good, simple job showing what does money manager research mean. There's over 16,000 money manager strategies out there, people that employ a bunch of CFAs and everything in that realm. We narrow it down to 247 people that have active roles in our portfolio. A very easy way to think about it, we try and build the best track and field team year in, year out. We want the sprinter in the sprinter event, high jumper in the high jumper event, and so forth. You go to the early 2000s is when we launched tax managed models or tax managed solutions. The reason that we did it was because we saw advisors using our retail solutions with both taxable and non-taxable assets. And we said, hey, let's create something that is explicitly designed for taxable assets, right? You will see a variety of naming in things out there, tax aware, tax managed, tax sensitive, everything under the sun as taxes become more of an issue today. Take any problem in life and ask yourself if you'd rather be aware of that problem or if you'd rather actually manage that problem, right? Some funny ones that we always use, I'm aware I shouldn't eat a bunch of Chick-fil-A, probably better if I actually manage that, right? For anyone that has kids, if Johnny comes home with an F, an aware parent would say, good luck, go get him next time, right? If you're gonna actually manage that problem, you're gonna study with them, instill different habits, do things along the line to actually manage that problem, which gets into the things that we do in the tax managed fund. So if you bring up the 1099 guide, this is the space that we've lived in for a good 20 years, again, back to 2003. That box at the bottom does a good job of showing that gross return and net return. Again, in a very general sense, we don't want to give Mike any surprises year in, year out. Every investment you make has a purchase value and a market value at the end when you go to sell it. With the tax managed funds, we look to limit all of the liabilities in the interim time, right? If my investment isn't distributing cap gains, if all of my interest income is coming from muni bond funds, it doesn't matter what bracket I'm in, year out. The only time it matters is when I go to actually sell the position, and I'm probably gonna pay the best tax rate out there, long-term cap gains, right? So again, it's back to that aspect of taking control over that situation. Another really good term to think of when it comes to taxes. Everyone is worried about the cost of their investments, the cost of the solutions. No one worries about what they're paying on taxes. A good phrase I always use is a government expense ratio. We want to keep that as close to zero as we can. And that will get into what we do within those tax managed funds. And the big thing that we're going to do is we're going to tax loss harvest day in, day out. Now, we'll start to get into our new solution of direct indexing and break it into tax managed funds as well. In the tax managed funds, all of that trading activity is happening inside the fund. So what do you see year in, year out? You get a single page 1099. You have access to a bunch of managers, but on your statement, it shows 6 positions. It's a pretty clean, easy statement. Now, the downfall of that is we can't distribute losses to the client. Right? The only way you can take the loss is if you sell the fund, wait the 31 days, and get back into the fund. The benefit of direct indexing is you're going to start to own the underlying parts of the vehicle. So if you go to the educational brochure, I love these 2 charts, or these charts across the board, because it's going to hit on the general aspect. I always say, hey, you're going to make money and you're going to lose money. And people will say, well, what do you mean? How do you do that? Again, we're going to make money priority 1, and you're going to lose money. So I always caution that and say, because what happens is people will go home and they'll say, hey, heard about this great strategy where they're going to harvest me losses, they're going to lose me money, and then someone's going to say, well, hey, they're going to make you money first, right? First and foremost is you track whatever given index. So who here knows what the S&P 500 is? Show of hands. So good general knowledge, right? S&P 500 consists of the 500 largest companies in the US. These blue bars or red bars or gold bars at the top is going to show the overall return. Right? So the past 2 years in the market have been really good market years. The index returned 26% in 2023, and it returned 25.02 in 2024. Just because the market is higher does not mean that every single name is higher, right? So we want to own the parts of the vehicle rather than the full thing. So every 31 days, we can go into your account, we can trade what's at a loss, and we can still track the market by aligning the right sectors and being in the right names. So you look at a year like 2024, return 25%, but 374 names were down during the year, right? We're still going to return your 25%, but we're going to take advantage of those names that were down during the year. And to JR's point, how does that look at the end? You're going to get a big old tax statement that shows the 300 to 500 trades we did on the year. You're going to get a nice summary page as well, but you're going to give it to your CPA and you're going to say, hey, here's X amount of losses. Do whatever the CPA does with them. If you don't have any offsetting capital gain, business sale, land sale, if anyone has owned their house for many, many years and it's above the $500,000 limit when you go to sell it, house sale, stock sale, those things you can start to use more than $3,000 in losses per year to offset that sale. So let's just say you sell a business for $1 million, but you have $200,000 in losses banked. The IRS thinks that business sale was $800,000 rather than $1 million. We also have things that track the Russell 3000. We have an international index. Everyone has hated international up until this year, which it's outperformed the US by a good 10 to 15%. But there are always going to be opportunities across the indexes, and that's why we want to own the parts of the vehicle. So if you go to the next sheet, it's going to start to show some of the numbers and put actual data behind what we've been able to do in the strategy. If you funded this account January 1st of 2024, you're going to return 25.31%. So let's just say you put $100,000 or $1 million in there for easy math. Year end, your market value is going to be $125,000 or $1.25 million. The light blue bar, you can look past that because I'm going to assume that JR is not charging you 3% to manage your money. That's thanks to our friends at the SEC. For any general client materials, we have to show max advisory fees. The orange bar is going to be the losses that we were able to generate on the year. Even though the market was up 25%, there are blips in which you're able to harvest losses as long as you're trading every 31 days, right? Here you harvest some, you're able to harvest a little bit month by month, you get some at year end. So overall, you harvested 3.82% in losses. So your statement says you made $25,000. Mike says that you lost $4,000. Again, in a very general way to put those numbers. And obviously, the more money you put in the solution, the more losses you're able to carry forward. And if you have offsetting capital gain events in the future, you start to use all of those losses. You can't pass losses forward, so make sure to use them before you pass away. But again, it's a concept that says, hey, we want to own the parts of the vehicle rather than the full thing, because opportunities are always there as long as we're actively trading the market. And now, why does JR partner with a firm like Russell Investments? Because he doesn't have time to watch all of your accounts and trade them every 31 days, right? For anyone that sets it up today, it's going to trade 31 days from now. If you set it up a week from now, it's going to trade 31 days, right? So everyone is doing this similar thing in tracking the index. Trading what you own, tax loss harvesting, all of those things become unique to your specific account. Would also bring up the ability to personalize the account. Now, there are two distinct types of people. Have me own whatever. That's why I invest to make money. I really don't care what it is. There's also the ability to put screens on the account, Catholic values, oil and gas, alcohol, fur and leather. You can restrict individual names. You can build your own custom index, right? So if we take a step back and look at the S&P 500, my sticking point or sticking question is always to say 2 options. Generate a market return in no losses with SPY, IVV, VOO. If you're aware of ETFs, and those are just the big ones that track the market. Option 2, hold the underlying parts. Hold 5 shares of Apple, 3 shares of NVIDIA in X amount. Take the losses and generate the same return. Again, first and foremost, we're going to generate you the market return. If the market returns 25% and our strategy only returns 10%, it really doesn't matter how many losses we harvest, right? So first and foremost is to track the index within 0.5%. Second, we harvest the losses whenever they're available.
Again, I do want to thank all of you for being here. We appreciate your business. Just know that each and every day, we do not take your business for granted. We work hard to, again, try to find ways to provide value to you. So you are certainly more than just an account to us, and we sincerely appreciate your business. Hopefully you found this valuable. We love input, so if there's something that we could have done better, maybe took all of you to play golf this afternoon. But no, we appreciate it, and we appreciate your business. Thank you for your time, and if you want to stick around and talk to Mike or Alex or Brad or us, you're more than welcome to, but thank you for being here. We appreciate it. Thank you.